Special, the select committee back to order. So the next item on our agenda is the performance compensation report. So Treasurer and Mr. Swindell and Sam, if you guys are on the list as the witnesses today.
Raise your right hand.
Yeah. So, Mr. Treasurer, welcome and go ahead.
Thank you. And I have my notes courtesy of Matt Sackett, because Matt is the guy that does all the work on this stuff. And I want to thank him for his diligence in the performance of this. And essentially where we're at is we're still finalizing the numbers, and we'll present these to the IFC in mid-December for approval. We can say our alternative assets lag our financial year numbers until October. And there's been some manager delays in those alternatives also. That the total fund performance exceeded the benchmark with an estimated alpha production of over the benchmark of around $51 million.
How much? Excuse me?
51
million? Okay.
And
That was our alpha.
what's that?
That's our alpha?
That's our alpha.
Okay.
Yeah, that's the amount of funds over the benchmark. And we're still verifying the specific asset calculations overall. Asset classes performed above their benchmark except for hedge funds. And the hedge funds primarily in that was the hedge funds we have, we're looking for funds that actually produce profit, don't I guess fly into these meme stocks and different things like that. And there was also a few short positions that they had taken that didn't pan out in some of the funds. And that's primarily why the hedge funds underperformed a bit. On that, to the details, I would say that that's Patrick or Matt Schmigosh on that one. We'll provide you.
Mr. Treasurer,
Yes.
is your mic on?
Yes, Mike.
Can you pull it down a little bit? My guess is that anybody who's listening online is having a hard time hearing you.
Okay.
Thank you. That's
All
better.
right. Oh, yeah. Okay. We got a little echo now, so that'll work. So I guess just the recap is that, yeah, that we've exceeded our benchmarks by 51 million on the total. The only funds that haven't exceeded is the hedge funds. And we'll provide you a report once the IFC has received and approved the performance compensation plan.
Okay. So the good news is there's going to be some performance compensation due.
Yes, that's the good news. And I think the investment team has promised to take us all bowling for that. Yeah. But we got to buy our own beer.
Okay. Good. Thank you. So Dave, do you want to take it up from your side?
Thank you, Mr. Chairman. Again, I'm David Swindell, the Executive Director of the Wyoming Retirement System. I thought, Mr. Chairman, what I'd do is I'd just remind the public that may be listening and to members that weren't involved with the legislation a little bit about the structure of the program. Then I'll discuss our results. I may ask Sam to talk a little bit more about attribution within the performance portfolio. And then I'd like to talk about some more recent results that I have for you, including the little theater I've got stood up for you. Would that be okay?
Sure. We enjoy theater. We enjoy the arts.
Thank you, Mr. Chairman. A little bit of background then. The legislature enacted the Investment Performance Compensation Program in 2019 to address recruiting and retention issues in both Treasury and the retirement system investment staffs. The material terms of this: additional compensation for the team is authorized if the performance exceeds established benchmarks. The period considered is a rolling 3-year period. Now, this is year 2 of implementation, so this period is a 2-year period, which covers the period 1 July 2019 to 30 June 2021. Last year was a 1 year. Next year, it will be a full 3-year rolling period next year and thereafter. The bonus pool is 2% of alpha dollars, which is the dollars that are earned above the benchmark performance. The bonus pool is then further limited as a percentage of base pay. The chief investment officer can earn up to 100% of his base pay. Seniors, investment officers, 75%. Investment officers, 50%, and analysts, 25%. In the retirement system, the performance is based upon the performance of the total WRS portfolio, not any particular asset class like equities or fixed income. The payments are vested over a 3-year period. We pay out 25% in year 1, 25% of what's earned in year 2, and 50% of what's earned in year 3. A report is required by 1 November of each year to the Joint Appropriations Committee and this committee, and that is the report that's in your packet. So how did we do? The 2-year period results, the team outperformed the benchmark by 1.39%, representing an approximate alpha of $253 million of added value. The 2-year return was 14.2% versus the benchmark of only 12.81%, and outperforming our long-term actuarial goal, which is 7%. They earned the full reward. 2% of $253 million is $5 million that is available for the bonus pool, which is more than enough to overfill it. The bonus earned to 7 individuals per statute was $745,687, and 25% of that will be paid this year. This represents only 0.29% of the additional value add. And with only 25% paid this year, that would be $186,422. That's only 0.07% of the additional value add, or the alpha dollars, as you mentioned, Mr. Chairman. The benchmarks were approved by the board, reviewed by the Investment Funds Committee. Calculations were verified by the WRS Finance Department, our internal audit department, and the board's internal or external investment consultants, Makita and Company, all in accordance with the plan that's been submitted to the legislature. The risk in the portfolio was less than the board's asset allocation targets through the entire 2-year period, and had a higher Sharpe ratio than the benchmark. We were 1.3 versus 1.2. And our Sharpe ratio was higher than the peer median, 1.3 versus 1.1. And that implies more return for each unit of risk compared to the benchmark and peers. And that means that the outperformance wasn't gained by taking excessive risk to either the board's allocation targets, because we had less in equities and other risk assets than the board's targets actually were, and compared to our peers. Mr. Chairman, the outperformance was spread broadly, mostly by hitting lots of singles and doubles and not having many strikeouts. We didn't hit a lot of the home runs. We had a really good on-base percentage. Every asset class outperformed its benchmark, and private equity was the highest performing class. A little bit about future investment or estimated payments. I don't know. We will pay out the next 25%, the next 50%. We know what's been earned. We know what was earned last year. No one knows what the next investment results will be. I will tell you that I would not expect us to achieve our benchmark every year or outperform it in this way. It's not that easy. I do think that the structure in place is pretty solid. And I think in most years, I do hope that our investment team will outperform and you'll be able to pay performance compensation to them. Sam, I'd like you to discuss a little bit, if you would, about the portfolio over the last 2 years and what you attribute the outperformance to, at least in general terms.
Go ahead, Sam.
All right. Thank you, Mr. Chairman. And Karen, if you wouldn't mind pulling that page up, please. Okay. That's great. If you could go to the next page, please, page 2. So this shows the performance by asset class with the total fund rounded here 1.4%. I'm looking at marketable equity. So the blue bars are our portfolio, and green is the benchmark. So marketable equity was up 19.6%, outperformed its benchmark by 90 basis points. Private equity was the strongest performing asset class at 28.3 versus 22.9 for the benchmark. Fixed income outperformed by 1.4%, which for fixed income we're very pleased with. Private debt outperformed by 80 basis points, marketable alts by 4.8, and then private real assets by 1.7. And unless anybody has any questions, I'll flip over to the, Karen, if you wouldn't mind switching to the first page. Correct. Great, thank you. So just want to point out private equity here, you can see was up 57.3% last year. And that's one area that we've been building out over the last 5 years that's really starting to make an impact as it's become a bigger part of the portfolio. And we inherited a lot of legacy investments that weren't performing very well. So those have just been running off over the years. So I think that that's an area where we can continue to see some really strong performance. And I think private debt as well. That's an area that we've revamped over the last couple of years. So that was one of the weakest asset classes in the portfolio. And now it's doing quite well. So we've got some great new funds in there and looks promising. So I'll just pause there. That's all I had for some of the high level attribution, unless anybody has any questions.
Okay, thank you. Questions for Sam or Dave?
And Mr. Chairman, I'd like to finish up with the chart that's on the chair. And you had some paper copies at the dais. And Karen, I think you can pull that chart up, can you not? Yes, there it is. This is a little bit of an update from the report. The report was dated as of 30 June. This is as of 30 September, so it's 90 days updated. This is the report that was reported to the Wyoming Retirement Board just a couple of weeks ago. My apologies to Senator Nethercott and Representative Schwartz, who were legislative liaisons. You've seen this, so I apologize for the repeat, but we do really have a couple of really strong legislative liaisons, Mr. Chairman, so I do point out their efforts. This chart talks about the performance of the portfolio as of September 30th, 2021, and compares the total fund on the top line to our strategic benchmark, to our peers, to our reference portfolio, 60% equities, 40% bonds, and to our 7% actuarial target, and does that over multiple periods, quarter to date, year to date, 1 year, 2 year, 3 and 5 years, 7 years, 10 years. And then compares it. If you notice, it's all green. We have outperformed our strategic benchmark, our peer median returns, our reference portfolio, and our actuarial targets over any period that you want to look at on the chart. It's rare. You won't see this very often. Because usually what has to happen is you've got to invest at least a little differently than the benchmark of your peers in order to beat them. And for a short period of time, even the market may not agree with your investment decision right away. But I just had to show you this. I want to point out a couple of things. If you look at the 3 and 5 year areas, which are highlighted in gray and highlighted on the chart, I think these are the most relevant ones because that really reflects this team's performance. Sam's been with us for 7, 8 years, but he didn't have this team in place all that time. It took time to build the team. Prior to 2009, the Wyoming retirement system didn't even have the position of chief investment officer. Allocations were made by the board. They selected the managers. So it's been an evolving thing, but the team really owns the performance over the 3 and 5 year period. I look at the peer rankings in the middle. This is peer systems. I think there are 77 or 80 funds that are tracked by the consultant, all with $1 billion or more under assets. That's the peer ranking. We are in the 4th percentile over the last 3 years. The 4th percentile. That means we beat 96 out of 100. We're in the 26th percentile, basically top quarter performance over the last 5 years. It's really good. And you get that by consistently kind of being in the top half. If you were in the top half year after year, you will suddenly find yourself in the top quarter over a longer period of time because most people can't hit singles and doubles that consistently. They'll strike out. The other thing I would point out is if you look at the peer ranking over 10 years, clear on the right, it's 49. That's middle of the pack. It was 50 to be exactly middle of the pack, right? Well, how did you get from top quarter over 5 years to really just be in middle of the pack over 10 years? That means that earlier 5 years wasn't so good. You were bottom quarter, and that's where we were. And so this represents, with this legislature's assistance to build out the team, provide us minimum administrative resources that we've done well for you. We've done well for our members. And so that's the update as of 30 September. Right now, we're up 12.77% for the year. No one knows how we're going to finish out for the fiscal year. Our fiscal year ends on 31 December. That's what's involved with our actuarial reports and so on. And we'll see. As you know, markets have remained volatile. The Dow was down 900 points on Friday, but it rebounded yesterday. We'll see how the year ends, but we're up double digits so far for the year.
And those are all net returns, correct?
These are all net of expenses,
Net of
correct?
expenses. Thank you.
Thank you, Mr. Chairman. Stand for any questions.
Go ahead, Representative Schwartz.
Thank you, Mr. Chairman. So the bottom row is the actuarial target. What's your timeline for reviewing that?
Whether 7% is a good actuarial target, the board's in the process of doing that now. They've reviewed it the last couple of meetings. They've had some presentations from the actuaries. The actuaries have recommended to the board that they could stay with 7%. They've done a review of it. They could lower it. There's a potential to lower it to 6.8%. At 2 weeks ago, the board decided to adopt new mortality tables that were recommended by the actuary, which will cause a little reduction to our funding status. They deferred on the decision to whether to adopt 6.8% or to stand firm at 7%, and they'll consider that again in February.
Okay. Any other questions? Thank you very much.
Oh, well, I might add one more thing. The 7% target, how normal is that? Well, a year ago, the median across all large public pension systems in the United States, 128 systems tracked by our national association, was 7.25%. Since that time, a number of other systems have adopted lower assumed rates of return, including some that are lower than 7%. And right now, the median is exactly where we're at 7%. And so right now, the group has come back to us, and the decision for the board is, do we see a reason to move any lower or not? What's happened, of course, is that the consultants are looking at the last 3 years of outperformance in equities and say, well, you're not going to do that. These current returns are robbing from future returns. So they're saying future returns will be a little lower. Maybe that's what the board needs to plan on, because this number really is the key number looking out over 10, 20, even 30 years. And so we'll consider all that. But there could be a modest 20 basis point change. We'll see.
Okay, thank you. Any other questions? Appreciate your time. And thanks for your good work. I mean, obviously, that's all good news. We'll see how it happens moving forward.
Mr. Chairman, when the numbers are good, it's always good news.
Future performance. So. All right, so we're now to Treasurer's Office reports. So, Madam Deputy Treasurer and Mr. Treasurer.
Mr. Chairman, I'm putting Don in the center because she's the gal that looks after this stuff.
All right.
Good afternoon, committee. Mr. Chairman, Mr. Vice Chairman, my name is Dawn Williams and I'm the Deputy State Treasurer. I can keep it brief. We've seen each other, it seems, very often, so not much has changed since September. We do have some big news. about our accounting system. We have made a decision to move forward with upgrading our existing system. And we, after extensive deliberation, we are set and poised to be operational with a go-live date of July 1st, 2022, which coincides with the new biennium. So we're very excited about that. We currently have 5 vacancies in the agency, 2 admin positions, 1 accounting position, and 2 investment positions. We are actively recruiting and anticipate that 1 of our admin positions and 1 of our investment positions will be filled by the January 1st. We have our budget hearing tomorrow afternoon with the JAC, so I'll see many of you again tomorrow afternoon. Within our budget request, we attempted to transfer and reclassify some of our existing vacant positions to accommodate some of the needs of our agency, such as accounting positions and legal assistance. However, the governor did deny those requests pending the outcome of 244, House Bill 244. And I would say, frankly, we can't build a budget pending an outcome of a report that I don't know what the legislature is going to do with. And if you did do a bill, I don't know what the outcome of the bill is. And so I felt like that was a little unfair to use that as a reason to deny the request for us to create some efficiencies within the agency, because at the end of the day, we still have a business to run while all of these changes are pending. So I'll be talking to some of you about that more tomorrow. Finally, I know that you've been very interested in our practice of making in-kind transactions to avoid fees, but that has resulted in us deferring resulting gains and losses. The chairman and vice chairman have solicited additional information from us since your last meeting in September, to which we replied. We even had an in-person meeting then with the chairs, the SAO and our office. And those responses are all included within the meeting materials. The bottom line is that the treasurer's office is proposing to modify our use of in-kind transactions, or modify our policy, so that effective December 1st, we have to propose this to, we have a board matter pending in front of the State Loan and Investment Board on Thursday. We have to obtain their approval to do that, because this would require us to retain a higher cash balance in the LSRA bottom tier, and we will have to modify our investment policy statement. Most of the requests for generation of income come from the loans that the legislature has authorized from the LSRA, and most especially by the Department of Education for School Foundation Program funding. And just this year, we are already up to almost $150 million that the department has requested. And that's a lot of movement that needs to occur to generate that much cash. So again, this ability to retain a higher cash balance will greatly reduce our need to make these trades to cover these requests for funding, especially from the Department of Education. And we will utilize those realized gains and losses from those cash transactions to recognize the unrealized in-kind gains and losses that I know that you've all had a concern about. But the downside of that is that it may take several years depending on the kinds of investments that will need to be sold to generate those actual cash earnings. That concludes my update.
Okay, thank you, Dawn. Questions for the deputy treasurer? Thank you very much. We look forward to, we'll have some more discussions tomorrow too. So look forward to that. Okay. Mr. Treasurer, anything to add?
I look forward to those discussions tomorrow, and I hope that we can get some forward movement on things that we can all agree on, irrespective of any possible proposed legislation.
Go ahead, Representative Obermuller.
Thank you, Mr. Chairman. I went through the in-kind transactions and the journal entries associated with that. And Mr. Chairman, I would just like to meet with them separately. I don't think we need to go through that here, but I have some input into that process that I think might simplify it greatly. So.
Look forward to those discussions, Mr. Chairman.
Thank you, Representative Obermuller.
You want to do that tonight?
Yeah. Okay, thank you. So with that, I think this, I think that gets us through to the, that gets us through your presentations. I think we're ready for staff presentation. Polly, on spending policy.
My computer's kind of catching up here.
Any particular handouts we're looking for, Polly?
Yes, sir. There are handouts under agenda item number 8-1 and 8-2. It is the draft copy of the committee's annual spending policy recommendation to the legislature. So let me share my screen again.
And then are you going to be referring to Appendix A1 and B1 also?
Yes, yes,
All right.
Mr. Chairman.
And those are at the back of the right side of your folder if you're doing hard copies.
Oh, something is going on with my screen here. Karen, maybe you can help me. I know. Yeah, maybe we can just. Yes. Full screen. I'm gonna share it. Okay, good. It's sinking. Okay. Okay, great. Okay, thank you, Mr. Chairman. Sorry for the delay and, okay. Good afternoon, committee. Polly Scott, LSO Budget Fiscal, and I'm here to run you through the committee's annual spending policy recommendation report, which you have in front of you. The committee is statutorily required to report to the legislative body on any recommendations for the spending policies prior to the convening of the session. So the report that you have in front of you is a draft and developed by staff, and staff anticipates that the committee will want to change or revise or amend it before submitting it to the legislative body. It's your report, and this is your opportunity to develop it in the way that you want. It starts off by just stating that a key decision for the legislature is how much of Wyoming's investments to spend in a given year, and also reviews the expressed priorities for spending policies that are in statute 94719. And there's 3 priorities in order of descending importance expressed in that statute. Consistent, sustainable flow of earnings, protection of the corpus against inflation, and to the extent practicable, increase in earnings. And this report is drafted with some highlighted blank areas where the committee's recommendations, once they're developed, will go, if any, and the committee may not have recommendations for changes. The report goes on to describe the 20-year history of the spending policy amounts, as well as the financial results for fiscal year 21, and then also briefly touches on the committee's interim activities. Table 1 really goes over the 20-year history of what the spending policies have been. Prior to fiscal year 2002, spending policies were dollar amounts that were in statute, and that's how the spending amounts were determined. Starting in fiscal year 2002, 1% of market value was put in statute. And Treasurer Meyer has made some recommendations that this could even possibly be in the Constitution. And the amounts have generally declined over the 20-year history that we're looking at. And it started out being 1% of the market value expressed as of the 5-year average, rolling average for the fund. And that 5-year average is a mechanism to try to smooth out the amounts that would be available for spending for government operations or schools. And some of you are very familiar with this and have been here as these policies have been developed, and others may be more new to this information. But the spending policy started out with the Permanent Wyoming Mineral Trust Fund, the PWMTF, and the Common School Permanent Land Fund, the CSPLF. Then in 2006, the Hathaway Scholarship Fund was created. That was created not with a % spending policy, but it is the spending policy for that fund is the amount necessary for scholarships for eligible students. And then in 2007, the Excellence in Higher Education Endowment Fund was established. That fund right now has a 4.75% spending policy amount, and that is, they're all legislated to be at 5% starting next fiscal year. And there's more detail about each of the funds in the appendices, and we can go over those if the committee would like. Generally, overall, as an overview for investment results, as you've heard throughout this meeting, the investment results have been very strong. The spending policies have been met for all the funds. Reserve balances are increasing, and 3 of the 4 permanent funds had a corpus tip for fiscal year 21. And we can go into more specifics on that if the committee would like. Then there's a section at the bottom of the page of page 3 on reserve accounts. And the legislature has set up a corpus and reserve account system for these permanent funds. And the reserve account serves to support and smooth out expenditures for the associated programs. And another aspect of our spending, as has been mentioned by the committee, is that the spending is restricted currently, legally restricted by the definition of income, which is interest, dividends, and realized capital gains. And so that is an additional component to the spending policies. Table 2 here has an estimate of the reserve account duration in years. And the duration for the reserve accounts has increased from last year when we were here talking about this. And so in years, the duration of the PWMTF and the CSPLF is about 4 years, estimated by Budget Fiscal. And for Hathaway and the Excellence in Higher Education, it is over 5 years. And Appendix B goes into more detail about how those estimates work, and also gives you an estimate of the spending policy amounts for the 5 years down the road. And then finally, the report really just ends with a brief statement about the interim work of the committee, with some blanks highlighted for possible next steps that the committee may want to take. And we would look for, and it's signed by the chair of the committee. And this is something that's required to be submitted to the full legislature prior to the convening of the session. We've put in a December date as a placeholder, and the committee can work on finalizing this as they would like to. And with that, I can move on to the appendices, where we get into more details of each fund, if you would like, Mr. Chairman. Okay. Okay. I think I'm trying to move on to my next share. Yes, there's 4 appendices in A, and okay. Yeah, that'd be great. That'd be great. Yep, flow charts. Okay. Thank you. My computer is kind of stalling on me for some reason. Starting with the Permanent Wyoming Mineral Trust Fund, and you've seen these charts before, and this is the finalized information, whereas last time it was estimated, as the fiscal year was not completed. The Permanent Wyoming Mineral Trust Fund, starting at the top there, is funded, of course, with the 1.5% constitutional severance tax income. The red elements on the chart are things that were changed by 2021 Senate File 121. And so the red box there shows that it's been legislated for the 1% statutory severance tax to also be contributed into the corpus of the PWMTF. And that's between fiscal year 23 and 28, it's half of that. And then starting in 29, it's currently legislated, it would go to 2/3, as well as currently the budget bill that is in effect is directing half of the 1% severance tax into the corpus. And of course, this is something that can be directed by statute. The market value for the fund was $8 billion at the beginning of the fiscal year. It's much higher now. The 5-year average of the fund, 7.8 billion. 5% of that for our spending policy amount is $388 million. Investment earnings or income, in this case, the interest, dividends, and the distributed realized capital gains was $490 million. So it exceeded that amount. And also was, just for your reference, nearly 35% of the general fund revenue this year. And so there was, all spending policies were met. Now, in 2017, one important part of the history of this fund spending policy is the legislature put in a guaranteed spending policy amount of 3.75%. along with the maximum spending policy of 5%. So in this case, with the investment earnings reaching the full 5%, all the maximum spending policy was met. The first 2.5% goes to the general fund for general government operations. That was 194 million. And then half of the investment income above 2.5% goes to the LSRA and the SIPA. But only the SIPA is guaranteed by the reserve account in the event that there was not enough. But in this case, there was. And so there's $97 million to each of those. The box to the right of the SIPA shows the subsequent transfers that are legislated. So what ended up happening is that there was $101.9 million in excess investment income that goes into the reserve account, as well as the reserve account gets to keep its own self-investment earnings. And that was 7.6 million. Now, something interesting that happened for the first time this year with the PWMTF reserve is that it provided a $6.1 million transfer to the Build Wyoming Loan Loss Reserve Program. And so that is subtracted out. And your balance, June 30, 2021, was $410.5 million in the reserve. And that's an increase from last year of $103 million.
I'm sorry, just a quick question. That was transferred to where?
It's the Build Wyoming Loan Loss Reserve Account, and that is legislated. That's allowable. It's.
What town did that?
You know, our state treasurer's office may know more about the specifics on that.
I thought it was you.
Maybe not. Maybe not. I'm not.
So I don't, so it was, is there, you know, was there actually a loan loss on the Build Wyoming LDI?
Mr. Chairman, I am not really
Okay.
familiar with exactly how that works, but there was a 6.1 million transfer to that
Okay.
program.
So for members of the committee that look at all your stairs, what was it? How many years ago was that? 4 years ago? 3 or 4 years ago, the legislature passed the Build Wyoming, and what it did, it allowed political subdivisions like towns and cities and counties to borrow from the permanent trust fund. And there was a slight, based on the number of years, there's a scale of how much they can borrow against that and how much the interest they have to pay. And so there were loans, but in order to protect, because they come out of the corpus of the permanent trust fund, there has to be a loan loss reserve to protect against loss of corpus if somebody defaults. And so we set this up, so this now starts to develop the loan loss reserve for that Build Wyoming account. And last we checked it, I think we checked on it last year, and nobody had taken advantage of the Build Wyoming thing. And we'll see how it is with infrastructure bills coming out of Congress. We'll see if anybody takes advantage of it in the coming year either. So anyway, that's,
yeah.
but we digress. Go ahead.
Yeah, Mr. Chairman, so we can move on to A2, which is the Common School Permanent Land Fund. Karen, if you would move on for me, thank you. So the revenue coming into the corpus there is shown at the top. It's the sale of school lands and 2/3 of production of the sale of state mineral royalties and easements and surface damage payments, as well as this fund currently, it's legislated, is going to be receiving kind of the other portion of the 1% statutory severance tax that isn't going to the PMTF. So it's right now 50% of the 1% statutory severance tax. And in fiscal year 29, it'll go to 1/3 of that. And that's what's coming into the fund. And the market value at the beginning of the fiscal year, July 1 or June 30th, is 4.1 billion. The 5-year average, 3.9 billion. The 5% of that is 196.1 million, which is fully met by the 232.1 million in investment income. And in this case, it truly is the interest, dividends, and realized capital gains, the classic definition of investment income. And there's an interesting thing that is indicated by the triple asterisk at the bottom of the flow chart. In years when the investment earnings exceeds the spending policy amount, there's an automatic swap or an automatic appropriation of over the cap federal mineral royalties that go into the reserve account. And that is to accommodate the constitutional restriction that the investment income can only be spent by the school foundation program. And so we had 36 million flowing into the in reserve account, as well as the self-income of 6.6 million going into the reserve account. The maximum of the reserve account is 150% of the spending policy amount, and that calculates to be 294.1 million. We've reached that maximum, and there was a $16.6 million tip into the corpus for this fund.
Mr. Chairman,
Go, yes, Senator Kinski.
Paul, I've got a question. That top paragraph, the last two lines says the Common School Public Land Fund reserve account will receive 1/2 of the revenue stream from 1% of severance taxes and 1/3 in 2029 thereafter. It indicates it's going to the reserve account, which is not consistent with my recollection. And then the chart shows it going directly into corpus, not into the reserve account. So I'm
Yes.
confused there.
Excellent observation, Mr. Chairman and Senator Kinski. That should not say the reserve account. It's going into the corpus.
Thank you.
So the diagram's right, and we just need to cross out the capital R, capital A in that second last line.
Mr. Chairman,
Okay.
I would appreciate that. I agree. Moving on, if there are no other questions, to the Excellence in Higher Education Endowment Program. These are the two smaller permanent funds, and these funds, this is on A3, do not have revenue coming into the corpus, and the only revenue for these programs is from the investment earnings. So for this fund, the market value is 119.5 million at the beginning of the fiscal year. The 5-year average is 119.8 million. And the spending policy right now is 4.75% of the 5-year average market value, which calculates to be 5.7 million. That's legislated to go up to 5%. That's in red at the bottom because that was part of Senate File 121. And so that's in excess of the investment earnings of 7.2 million. And so we are going to have 1.5 million flow into the reserve account, as well as the reserve account gets to keep its own investment income of 0.3 million. So it's 1.8 million. So we're going to be, we bumped up to the maximum, which is 150%. If there's questions, just let me know. And so the maximum is 8.5 million on the reserve account. And so this account, the way that this account works is there's a flow back and forth between the income account and the reserve account as these benefiting institutions need to spend money throughout the year. And so you can see that demonstrated here. As well, the legislature has put an additional reserving practice in place for this fund where the benefiting institutions are required to keep a 10% kind of buffer for years when there isn't as much investment income. Now, last year, the reserve account went over the maximum, but we had a kind of a temporary hold on corpus tips in the 2018 budget bill. So the legislature put a special piece of legislation in the section 300 of the budget bill to take care of that. And there was a $10.6 million corpus tip in fiscal year 21, but it was really representing fiscal year 20. For this year of fiscal 21, the $1.7 million tip is what has occurred. And
So is that, will that be, so the corpus will increase by the 10.6 million?
yes, as well as 1.7 million.
And
So
the 1.7 will flow out over that direction too, correct?
that's correct.
So
That's
it'll be 12.3
Yeah.
total.
And so the corpus is now around 140 million, so, but the number that we're basing all of this on is the beginning of the fiscal
Right.
year.
Right, thank you.
And then the last one, Appendix 4 is for the Hathaway. And again, smaller fund does not have a revenue stream like our two big funds. The market value at the beginning of the fiscal year, 592.2 million, the 5-year average, 585.2 million. Investment income for the year, 31.9 million. This is the one where it's not a percent, it's the amount necessary for scholarships. That was 17.1 million. So there was 14.8 million left to flow into the reserve account, which then created a corpus tip of 13.9 million. And I did want to mention for the committee that the Joint Education Committee, and I know that some of you are very familiar, has a bill to make some changes to this fund. And this flow chart demonstrates that kind of the flow back and forth between the expenditure account and the reserve account. I believe the Joint Education Committee bill is proposing to eliminate the reserve account and just have the expenditure account kind of streamline that. Increase the cap. The cap on this one is 4.5% of the 5-year market average, which is 26.3 million at this point in time. They're proposing to double the max to 9%, which would be 52.6 million. And
So it's set,
yeah.
it's basically set at 100% of the spending, there's no spending policy, but it'll double that.
right.
So it takes it basically 200% of what, okay, got it, thank you.
Okay. And I think the other couple of things that that bill is proposing to do is to authorize this reserve account to be in Pool A, as well as increase scholarships by a certain amount. Just for your information, that's something that's at
Well,
play.
But I thought you just said that that the bill was going to eliminate the reserve account. So what would you put in Pool A if you eliminated the reserve account?
Mr. Chairman. Can I,
You were on the education
Yeah,
committee.
Mr. really, if you look at that flow chart, it combines the expenditure account and the reserve account. And really the problem is, Hathaway started out at 405 million, is the original deposit. And it's up now, I think, September 1, I was just looking at it, it's 566 million right now. So it's grown by over 100 million in the last year. So there's plenty of money to fund scholarships. The problem is the timing, because July 1st, the law says it all sweeps, anything from the expenditure account sweeps the reserve account, and then it tips a few weeks later, anything over the 150% or the 4.5% cap in this case. And then colleges have to pay their bills. These scholarships come in August. So now we've taken the money out of the expenditure account, swapped it from the left pocket to the right pocket, the reserve account. Now it's tipped into the corpus. And they say, hey, we need now 12 million bucks to pay scholarships. So now it flows back from the reserve account to the expenditure account. All this left pocket, right pocket stuff's going on. And it's all because of a timing issue. So basically we've set up one account, a little larger account, but we've allowed it to be invested into Pool A as well. And so you won't have this back and forth timing issue. So it's going to increase returns and take care of that issue.
We look forward to hearing.
Senator Scott will carry this thing with unbridled.
He was green from ear to ear. It's nice to see you and Senator Scott getting along.
It's wonderful. It is. It really is a good maneuver. And I think, you could probably look at it with the higher ed, although we put in that other safeguard of the 10% reserve at the institution level is good as well. But the Hathaway's never run out of money. It's never gonna run out of money, but it creates a timing issue that some will say, oh, it looks like it's running out of money because we had to pull from the reserve account. That's because our statute says you have to tip from the expenditure account at the end of the fiscal year. And so that's been the issue, really.
Okay.
Mr. Chairman?
Yes, Representative Schwartz.
I'm going to ask for a privilege to ask a question to Representative Harshman about that. And you can say no,
Would you
and I'll
like him,
do
would
it.
you like him to go out here and sit in front of us?
No, I don't
Oh,
think
okay.
that's necessary.
You can
Well, I'm
stay-
just,
yeah, go
because
ahead.
following what you said, what I'm seeing is that the expenditures, the scholarship need is always less than the revenue. So we're constantly going through this tipping left, right pocket, but ultimately the corpus keeps growing, so the income keeps growing. But the expenditures are pretty stable around 18 million a year. So is the committee discussing ways to expand access to the Hathaway funding for other uses?
Actually, Mr. Chairman, there are proposals for some scholarship changes in the bill. This is just one little part of the bill that you'll see.
Okay, thank
As
you.
far as apprenticeships, those kind of things.
Already getting
Yes.
excited about session.
There you go.
Okay.
Mr. Chairman, the only other couple of things I have for you is you do have Appendix B, which Karen can maybe put that up for us. And it, again, it's B1, 2, 3, and 4. Appendix for
Yeah, put that
each
up,
fund.
Karen.
It's, yeah,
Oh,
yeah.
that helps.
She's good. She's good.
I was hoping I could see it bigger there because I
Yeah.
can't find the right range
Yeah,
on this one.
This is definitely the budget fiscal font. This really just shows you how we develop, how budget fiscal developed the estimates of the 5-year spending policy amounts and the balance and estimates the years of duration. One thing that may be helpful for your conversation on these issues is to look at the 5-year spending amount that is tallied up at the bottom. For example, for the PMTF, it's, the 5-year spending amount is 2.2 billion. And that would be the full 5% spending policy amount. And I know the state treasurer's office, has been on record in front of the Joint Education Committee saying that, they generally would look for a 5-year spending a policy amount to be in reserve before investing the reserve more along the lines of the corpus. I believe that's correct. And they're here so they can jump in, but just wanted to let you see that. And that's what all of these additional pages with
So
the
if I
small type.
understand, Paula, if we take the first page
Mhm.
on Appendix B1, this is the PMTF.
Mhm.
It shows us if we never had another capital gain just based upon the income.
Mhm.
And then estimated by Craig, and then took out the guaranteed 3.75% each year to make up the difference. This shows how when that would end, when the reserve
Right.
account would be empty.
Right, about 4 years of reserve for the PMTF, as well as if you flip over to the next one and you can,
It's the same, and it's the same things we go through.
Yep.
This reserve, the common school permanent land fund, that's a 5% guarantee. It's a little bit different, but you see the same thing there. And then,
and this is an increase. Last year, our estimated duration was 2 to 3 years for the
right,
reserve.
so
So
now
this
we're
is
out
an increase.
to 4 years. Yeah. Okay.
And so I will just call your attention back to the
And
memo.
one more point
Yeah.
to make on that, and just turn it over my right ear. And one of the reasons that this is important is because this allows it to hit the profile
Mhm.
and allows us to profile so we know exactly what we're anticipating that comes out of this.
Mhm.
And so that just makes everybody know that what we're going to have as we go forward to the budget because it's hit the profile. So there's
Correct,
no surprises with respect to things showing up. later.
correct.
Okay, thank you.
Yeah. And then I will just, if it's okay, Mr. Chairman, just remind the committee that you do have the spending policy report that you may want to discuss, general direction that you would want to go with finalizing it and direct staff and potentially even approve in concept the additional content that you would like to see in it.
I think, so working backwards on that, I think on page 505, as far as random work, we got to have our discussion at the end of the day, and then we'll be able to fill that in. On page 1, though, we do have the to be determined based on select committee direction. I want that as recommendations with respect to investment earnings spending policy on permanent funds. Does anybody have any particular recommendations that they would like the committee to forward with respect to the spending policies in this document? What's that? Maintain them. Well, I don't know if that's a recommendation. I think what that means is we ultimately, I guess that is the recommendation, just no change. Recommends no change in the spending policy. Is that your motion? We've got a motion, a second. All right. Any discussion? Any discussion? All those in favor say aye. Aye. Those opposed, no. Okay, that amendment is adopted. We'll take that up here in a bit.
Okay,
Okay?
yeah. And Mr. Chairman, I can be super brief about this if you would like, but you also have these big charts in your materials. And if you would like, I could just
Which one?
briefly go over those.
So which one are we? We're looking at the cost-based deposits
Yep, Yep.
for the PMTF and then the Common School Permanent Land Fund?
Yep.
Okay, go ahead.
Thank you, Mr. Chairman. Last time the committee met in September, there was some discussion about just the history of these funds in terms of deposits the discretionary deposits that had been legislated, as well as diversions or redirections. And this table, and I'd like to acknowledge my colleague, Dean Tempty, who really has developed most of this material. And I really just put it in good form for the committee today. But yeah, this gives you a 20-year history of the PWMTF, the cost basis, the constitutional 1.5% deposits going into it over this time frame, then the discretionary statutory 1% severance tax deposits, other direct appropriations, spending policy tips that have happened over the last 20 years. And then as well as the market value, which shows you the unrealized gains there. And then the last 4 columns really give you an estimate of the value of inflation during the same time period, using both the Wyoming Cost of Living Index and the Consumer Price Index for urban areas. And then if you flip it over, for those of you who are more visual, and you can see the same information in a bar chart. And the one piece of additional information that's on the bar chart that there just wasn't room for on the table is the third bar, which represents over the time period that we're looking at the amount of non-constitutional deposits that were redirected and did not get deposited into the corpus. That second bar there, that's basically the discretionary deposits that have been legislated into the fund. And the third bar is, or the fourth bar, the green bar, is the unrealized gain of the fund. And the last 2 bars, the blue bars, are the inflation. And that's really just for your background as you consider.
So a
Future.
quick question for you on the estimated annual inflation on the PMTF. Can you just explain a little bit more about how that's calculated?
Sure, if you flip over to the table, we have the percent of the Wyoming Cost of Living Index.
Yeah, you're going from second quarter, I get that.
Right.
So,
And so you just multiply that times the corpus and you get how much that is worth over that time frame, and you add it up. It's kind of like a negative deposit in a way.
and so if I'm understanding that right, is the correct, what is the correct comparison, the inflation value? Is it the total of all the non-constitutional deposits, the constitutional deposits, and less the ones that were redirected?
Well, certainly the ones that were redirected are really just kind of a different category because that was specifically asked for to know how much was redirected. But the interesting comment I can make in response to your question, Mr. Chairman, is really that there isn't a legislative intent expressed about what the deposits are intended for, if they're intended to offset inflation or if they're intended to increase the corpus of the fund. You know, it's really not specified when those deposits are made. So it's up to, it's really not something that staff can
So
determine.
as we look at the comparison, I mean, in my mind, it's like you'd take this multicolored graph, stick it on top of this one and then compare it with the inflation over there. Is that?
That's certainly a reasonable, fair way to do it. And another,
So in
way
other
of
words, we're
looking-
winning.
yeah.
Okay, thank you.
Yeah, one interesting comment is that if you had done this for fiscal year 2020, it looks totally different because inflation is much lower and the unrealized gain is much lower and
We'll see, we'll look at this again next year and see what it
yeah,
is.
yeah. But anyway, that was something that the committee had requested. You've got the same thing for the PM or for the common school, a very similar pattern. And with that, Mr. Chairman, that's all I had for you.
All right. Thank you, Polly.
You bet.
Go ahead.
Thank you, Mr. Chairman. Probably just, later next week or whatever, if you could kind of give us a little summary on what the chairman said, we're winning. And if you took that first chart, permanent trust fund, just real quick, it's like 6.5 billion in deposits. You do the market value, it grows to 8.2 billion. You take the inflation in the middle of those 2.5 billion. I don't know. I'm just looking just quick. But maybe you could give us a score on that then, I guess, and where we're at, what the chairman said. So we're not using, I'm not
Yeah.
scratching my little numbers. That'd be a quick deal. Just email it to us, say
I can
inflation's
certainly,
2.5 billion and we've deposited, and with market value, it's currently 8.2 billion. So we're winning by 6 billion or whatever the number. Thank you, Mr. Chairman.
certainly.
Okay, thank you, Polly. Any other questions for Polly? All right, thank you, Polly. Now we'll jump into Senate File 121. And is that Brian and that's Brian and Ian and other members of the Brain Trust that are not present? Okay.
Chairman, thank you. Eventually, we'll get some other charts up on that. I'll provide a brief introduction. I'll make it kind of brief because I think the committee is already, heavily in tune with what the Senate File 121 report is, as opposed to this House Bill 244 report. And so we won't go into a lot of that other than to say that 244 deals with the structure and the governance of the investment system, whereas 121, Senate File 121 deals more with the legal nature of the handling of those investments and what you can do with them. I guess I should introduce myself. My name's Ian Shah. I'm the Legal Division Administrator, and I'm with Brian Fuller, who's a Senior Staff Attorney with LSO. The special session sidetracked our efforts a little bit from our last meeting in September, but I think we made pretty productive use of our time. Since September, Brian and I have met with Patrick Fleming about some of the ideas about endowment models to better understand their advantages. And then we went back to our research and took a pretty deep dive into 4 states' investment models. New Mexico, North Dakota, Utah, and Idaho. That really, I think, sharpened our focus on what those differences are in Wyoming. And that's what we're going to present to you today is our research specifically on those 4 states and how they might help guide Wyoming in producing a different model, one that would embrace an endowment type investment structure, and some other decision points that I think it points out. Before we get started, I just wanted to mention a couple of the key points that Wyoming has considered and this committee has considered over the last years, and certainly this interim, because I think it best enables you to understand what the key points are of the other states' models. I won't go into a lot of detail, but clearly we've had a lot of discussion, for example, about the inviolate nature of Wyoming's permanent funds. It seems that this committee, at least some members, are dedicated to maintaining that inviolate nature. That's something that's discussed in terms of the research we found. Clearly, and one of the most important points is the endowment model and what that would mean for the state of Wyoming and how it's constructed in other states. You know, an endowment model would allow Wyoming not to be forced to generate interest, income, or dividends for the purpose of meeting its spending obligations, and instead would allow a fungibility between our investments and the available investment structures that can be used for long-term rather than short-term gains. We talked a lot about our spending policies, and we just got finished discussing that report. I think it's true that, to summarize, I think where we're at is that the will of the body seems to be to maintain some sort of a spending policy. You can question whether that's done through a constitutional amendment or in our statutes or otherwise, but there seem to be some benefits to regulating, putting a cap on the amount of spending while trying to use reserve accounts and other structures to provide some leveling out of good years and bad years and the amount of spending that's available. We haven't talked about it a lot, but one thing that's going to come up in these models is inflation proofing. You know, right now our spending policy amounts do something to inflation proof, and that is that after 150% of a spending policy amount is realized in a reserve fund, it tips over into the corpus. That's important, and that's, as Polly was discussing, has happened this year with, I think she said, 3 of the 4 funds. There are other ways to do that. And I think that specifically when we talk about Idaho's model, they wrap that inflation adjustment into the corpus, and we'll discuss how that's done. Finally, I think we've had quite a few discussions about the size of our reserve funds themselves and the limitations those create, because you have to have some sort of a liquid assets, because there are obligations against those funds that prevent a longer term investment strategy. We'll talk about those with a number of the funds that create either pooling of funds or other larger reserves that can create a larger pool to draw from. So I wanted to bring out those points just because I think they're going to be relevant to a lot of the states we discussed. But Brian is going to first talk about, I think, the first 3 states that we looked at.
Yep. Mr. Chairman, committee members, Brian Fullerla. So my colleague mentioned that we looked at 4 states. You'll notice in your materials, there are materials for 2 states, for Utah and Idaho. And there were reasons why we chose not to devote as much time both in terms of our research and today at the meeting as it concerns New Mexico and North Dakota. For New Mexico, we did not extensively study their structure and process, primarily because it appeared to us that at least their severance tax fund was not inviolate. And they did not utilize reserve accounts. So they didn't seem to be quite similar to us. The one thing I would note about New Mexico, though, at least for their severance tax permanent fund, is that the annual distributions are spelled out in their state constitution. And it's currently set at the amount of the annual distributions shall be 4.7% of the average of the year-end market values of the fund for the immediately preceding 5 calendar years. So I'm sorry, Mr. Chairman? 4.7%. Yep.
Thank you.
Yep, 4.7% of the average of the year-end market values of the fund for the immediately preceding 5 calendar years.
Okay.
And that was a constitutional requirement of New Mexico. North Dakota, the reason we did not focus on North Dakota as a potential model is that for their primary permanent fund, earnings was defined as net income, which we took to mean a very constricted and limited term, and explicitly one that excluded any unrealized gains or losses. So we did not see that as really a total return approach that warranted further consideration. So with that, Mr. Chairman, I'll jump into Utah. And Utah presents an interesting kind of approach, given that what they have done in the last decade is fairly similar to what the committee is doing right now in terms of the House Bill 244 study and the Senate File 121 study. So just by way of a bit of background, in 2013, Utah conducted a comprehensive review of its operations and investment structure for its school permanent funds. And in 2014 created, I think it's been referenced earlier today, the School and Institutional Trust Fund Office, SITFO, with a board that would oversee and manage investments of its school funds. I won't get into too many details about that board and its structure, but in that packet, in your materials with the Utah model, the included statutes, about the first 10 pages or so, are the statutes that establish that board and set out the rules and requirements that the board and that investment office must follow. Then in 2018, Utah, their legislature established a separate office, the Land Trust Protection and Advocacy Office, which oversees SITFO, primarily to advocate for the beneficiaries of Utah's trust lands and to help the public understand and support the endowments of those trust lands and permanent funds. Then after the changes in 2014, in terms of creating an investment office, a separate board, Utah made changes to its investment structure and moved to more of a total return model. And that was in 2016. And those statutory and constitutional changes are the last 2 pages in that packet, the statute and the Constitution. So to jump into those more specifically, and I should kind of cabin my discussion by saying that everything I'm discussing concerns their permanent funds and their school fund. So they have other permanent funds. This is focused only on their school funds as kind of the model and example. So Utah has 11 permanent funds. They range in value from about $2 million to nearly $3 billion. All 11 of those funds are pooled together for investment purposes. For their largest, the state school fund, the Utah legislature has established a separate trust distribution account, and any of the earnings, investment earnings and interest, and any unused appropriation for schools are deposited into that trust distribution account on a quarterly basis. Similar to Wyoming's active admission, Utah's active admission states that for schools and their permanent fund, the interest shall be expended. So there is that same interest limitation as with Wyoming. There is a definition of earnings as well in Utah statute, but it seems to be limited for the purposes of administrative costs. And they define earnings to be any of the following that is in excess of the trust fund corpus, to include realized and unrealized gains, interest, dividends, other income, or other revenue. So what Utah did in 2016 when they made their changes to broaden their investment opportunities and structure was to change language in their statutes and in their constitution to use the term earnings. So they moved away from the concepts of income and interest and moved to earnings. They created that trust distribution account in statute. And then their constitution, similar to New Mexico's, was amended to state that earnings could be distributed, and then it put in a ceiling for spending policy of those school funds. And that ceiling is 4% of the fund as calculated by statute. And I'll explain in a little bit what that process looks like by statute. One note, I guess, before I do, the distribution amount that was set in statute was initially based on an annual review of the past 12 consecutive quarters, so a 3-year rolling average. That was amended in 2020 to a 5-year rolling average. In terms of the word in Utah and the inviolate nature of their school fund, their constitution doesn't expressly use that term. But their constitution does state that the fund shall be guaranteed by the state against loss or diversion. There hasn't really been a good judicial interpretation in Utah of what that means, other than in one case, noting that the state university could not have unfettered control and custody of its permanent funds, while the state would be required to guarantee those for loss or diversion. In our conversations with colleagues in Utah, they noted that constitutional provision, that their belief was that it was meant more as a protection against misappropriating funds or lands, rather than a strict requirement for the recoupment of any investment losses. So in terms of the spending policy, The Constitution says it's 4% of the value of the fund. In statute, the distribution amount is the lesser of either 4% of the average market value of the fund or the amount of the annual distribution calculation. And statute provides how you reach that calculation. It is the average of 4% of the average market value for that fiscal year and the distribution amount in the prior fiscal year times the sum of one, the percent change in student enrollment from 2 years ago to 1 year ago, and then the actual total percent change of the consumer price index during the last 12 months. So their annual distribution calculation does capture an inflation as part of that metric. Statute is silent on what monetary investment sources can be used to generate or reach this required distribution amount that's calculated. And
Before. So at what point, I mean, what's the upper limit on the distribution, whether you're making the calculation for inflation or not? There's an upper limit on the overall distribution.
yeah, Mr. Chairman, that's the 4%.
And that's the
of the average
4%.
market value. And in our conversations with Utah, they noted that this fiscal year, they anticipate hitting that 4% ceiling. Up until now, they have not. They've always gone with that calculated amount in statute, but they believe that this coming year, they will hit that 4% ceiling.
And as you talked with them, is that cause them concern that this will not work into the future like they've anticipated it would?
You know, Mr. Chairman, I'm not sure there was specific discussion along those lines. You know, I get the feeling that, you know, maybe Mr. Shaw can add, but that there was little concern with that ceiling that they would be in trouble. You know, they used you know, their example was a Great Depression that lasted 4 to 5 years before they would, I think, start to feel concerned.
Go back and amend their active admission as part of this process. Is that right?
Mr. Chairman, Utah chose not to.
They did not amend their.
They did not amend their active admission. You know, I'm not privy to how they reached that decision. You know, as Mr. Shaw may explain, or one of us will talk about how Idaho did amend their active admission before engaging in the changes to their permanent funds.
Okay.
Then, Mr. Chairman, unless there are further questions, I'll move on. In terms of expenses, there is a separate management account to pay for SITFOs and the board's expenses. Statute outlines what that account can be used for in terms of audits, legal services, and so forth. It does provide that trust fund earnings can be used to pay for these costs. But it also appears from that statute that half of those expenses are paid through a direct appropriation from the legislature. So half would be an appropriation, the other half would be earnings. But the amount of earnings that are used can never exceed the amount of any legislative appropriation for a particular year.
Did you get a sense of what their educational budget is? Because, I mean, for Utah, this isn't a very big account in terms of what their cost of education is. So it really doesn't compare to ours in size wise and their dependency on it. Yeah, fair.
Mr. Chairman, I'm not very familiar with their, you know, budget or spending amount for each year.
Thank you.
But I mean, there's more school kids in Salt Lake than there are in all of Wyoming by far, like twice or 3 times.
Yeah. And to that, Mr. Chairman, I couldn't expound on the source of funds, you know, in terms of taxes and so forth.
And what is the source of funds? Part of the 7 school funds, basically?
Yeah, Mr. Chairman, Mr. Vice Chairman, these are this is their permanent land fund. Yep. And then, Mr. Chairman, moving on then to the concept of a benchmark or a floor or losses. Except for that constitutional duty to protect against loss or diversion, there doesn't appear to be anything in statute or their constitution that sets a floor or a limit for curtailing distributions if the fund loses value or if there are sustained losses. In our discussions with Utah, they noted that they distinguish between non-distributable funds and distributable funds. Both are invested together. And they noted that while the state may distribute earnings, if the fund were to drop below a previous year's average market value, if they reach a point where there are no distributable funds, there would likely be no distribution for a particular year. In terms of losses and kind of vis-a-vis the state or our state's Meyer rule, it's unclear whether losses are netted against gains. It does not appear that they are, though. Our conversations with Utah show that they focus on calculating the portfolio market value of the permanent funds, and they don't separate for losses or net investment losses against any investment gains. They noted that any losses they would have would simply be smoothed out over that 5-year rolling average. With that, Mr. Chairman, happy to answer any other questions.
Questions for Brian? Go ahead, Representative Larson.
So Brian, no reserve account?
Yeah, Mr. Chairman, Representative Larson, they didn't see that as a useful concept. I mean, the only other account would be their trust distribution account.
And follow up, Mr. Chairman. And so then if they have revenue in excess of needs, then that just automatically goes to the corpus and the corpus grows. Is that?
Mr. Chairman, Representative Larson, I don't think that was clear from the statute, whether they, to be frank, it just didn't come up in our discussions with him.
So do they make changes to their corpus? Do they actually have any kind of flow back mechanism? So their corpus increases, their corpus just the fixed amount as of the date they put this into effect?
Yeah, Mr. Chairman, I'm not sure that they have that kind of fixed date amount like Idaho does.
Okay.
So, Mr. Chairman, I'll talk a little bit about Idaho then. And one of the reasons that it's going to take a little longer to discuss it because it's a good model to consider. And I think it points out a lot of the things that this committee needs to talk about. The very questions that you had about what they do with their model aren't described in their statute or their constitution. And so it becomes a little bit difficult to tell what those are. By looking at Idaho, we have almost the exact opposite. It's the most of the funds we looked at, it's the most complete constitutional and statutory structure that if you read it, you kind of get a pretty good idea of what they're doing. And so we'll spend a little bit of time for that reason. It establishes either by their constitution or their statutes that the funds are inviolate, that it clearly establishes what we're calling an endowment model that separates itself from this idea of only earnings. They define corpus values for purposes of gains and losses. They describe exactly what gains are available for expenditure and how those are transferred. They define losses and then create a partial constitutional and statutory structure for when you have an obligation to repay those losses. So I think it's very instructional when we look at it. I point you first to I have two things that you'll want to look at towards the end of your packages of the Idaho Idaho model that I've outlined. And then you also have right behind that should have a flow chart. This flow chart, I'll give Idaho credit for, although I slightly changed it because there were some other points that I thought might be nice to make. But this is kind of their public outreach that they use when they present in front of committees and stuff when they talk about their structure. Idaho does maintain 9 different permanent endowments. And although the Constitution and statutes talk particularly and a lot about their school fund, all of those 9 endowments are still controlled by that similar law and constitutional and statutory law. And in our discussions with their investment folks, they indicated that even things like the repayment of losses are handled consistently across all 9 of those funds. Their funds range from $37 million in value to $1.17 billion. And as with as with Utah, all funds from all of those permanent endowment funds are pooled for the purposes of investment. Importantly, each permanent fund has an earnings reserve fund that, pursuant to the policies of the land board in Idaho, is targeted to accumulate, and I've said 7 years in my materials, but it's 6 to 7 years of annual spending before then amounts on top of that are subject for distribution according to the policies of the land board. Gains from each permanent fund, all gains from each permanent fund are transferred to the earning reserves fund. And from that fund is where all other activity takes place. So their permanent funds simply hold the corpus value from year to year, and their earnings reserve funds hold all the cumulative gains minus whatever is being expended. So that's an important point, is that the earnings reserve fund is, and all money that goes into it, that is the amount that's subject to expenditure, and only that amount. I think it's been mentioned that Idaho does make their funds, both under their constitution and statute, inviolate. So only those gains that are transferred to the earnings reserve funds are subject to expenditure. The rest are inviolate. This is perhaps a little bit out of order, but I think it's worth mentioning. I have a bullet point on their spending policy. And it's interesting that Idaho has made the policy decision to not put their spending policies in either their constitution or their statute. And instead, their land board is allowed to make decisions. Their current policy, I believe, is a 5% spend, or that's of a 3-year rolling average of the permanent fund's fair market value. Although in talking to their people, it's interesting that they apparently vary that amount from year to year, based on a couple different factors, including expected earnings, and that happens fairly regularly. I think one of the important things to talk about is when you get to the mechanics of how the Idaho statute.
Senator Larson. Or excuse me, Representative Larson.
Thank you, Mr. Chairman. So Ian, back up there at the beginning, you talk about their reserve account holding 700 or 7 years of annual expenditures. Is that actual expenditures for that, or is that the spending policy that you just referred to down below?
Well, I think it would be, well, that's actually just the size of their reserve, I guess, is how you'd quantify that. The spending policy, I would say, is also subject to their policy, but that's the 5% of a 3-year rolling average. All of that is subject to land board policy rather than statute or constitutional mandate.
Okay, thank you.
Sure. So the interesting thing in terms of nuts and bolts is how do they then determine what amount is transferred from this permanent fund into their earnings reserve fund? And that's a fairly simple formula. It may not be simple to actually to do and for them to calculate, but it's simple. They simply say that it's the gain above the corpus value. And then they define what that corpus value is. And that's kind of the beauty of the statutes. It actually tells you how to calculate it.
When you say the gain, you're talking about, doesn't matter whether it's realized or unrealized, it's just the difference in the market. It's basically the difference in the market value between the permanent fund corpus, we'll call it the corpus, they don't, but the corpus and then the current market value.
Exactly. That's exactly right. And it's that simple. I'm sure it's hard to calculate, but it's that simple. And I'm cutting to the chase, but it doesn't depend on earnings or interest or dividends. It's simply whatever that fair market value is. And so they then, through their statutes, find what they call the gain benchmark. And that's just simply a fancy word for what are you going to consider the corpus to be as you're trying to calculate the gain on top of that corpus.
Go ahead, Representative Schwartz.
Thank you. But Ian, when they make that calculation, they're also including the inflation calculation and the value of the corpus?
Correct.
Okay.
And in fact, that's what was my next comment.
That's another good segue question. He was going to already tell us about the adjusted
Let me tell you about
value.
Mr. Chairman. So that's correct. I mean, they call it their gain benchmark. And what that really is the way they determine the corpus value for determining gain. And it is the value of the relevant permanent fund on June 30th, 2000, adjusted upward for all qualifying subsequent deposits. And that would be like mineral royalties, land sale proceeds, appropriations, et cetera, plus an inflationary adjustment. And that's where, so in any year that there is a gain, before they distribute that gain, it's going to, the corpus value goes up to account for some inflationary adjustment. The only thing that's not included in their gain benchmark are payments that might have been made in the past for the circus for the purpose of making up losses, because that simply puts it back to where it should have been in the first place. So it spells it out. And it's helpful, at least for the purpose, for our purposes. The other thing they do provide for a benchmark floor, and that's more or less, I think, the cost basis of their corpus. That is to say that never can the gain benchmark fall below what they call the benchmark floor, which is the cost basis for the corpus. That's
Or what?
Or they'd violate the Constitution because it's completely consistent with the fact that the funds are inviolate. the corpus.
What if that happens because you have one, you have rampant inflation, and two, you have a significant you have a market meltdown, like, go back to a Black Monday or one of the meltdowns we've had in the last 20, 30 years. Pick one.
Right. Well, and I can say, I think that's consistent with the idea of having reserve accounts then, because it is important, I'll talk about this in a minute, but the fact that the corpus value or the fair market value of the corpus is less than the corpus value doesn't mean you're violating for the corpus for the purpose of making payments, because that all comes out of the reserve fund. And that's important because, you're not underwater and you're not violating corpus by continuing to make payments when the fair market value of the corpus is less than the corpus, because you're not invading the corpus still. And that's an important concept. And so that, of course, then relies on the size of your reserves. In Idaho, those reserves again are targeted for 6 and 7 years of spending. But what would happen when you came to the end of that 6 or 7 years and a couple of bad times there, Idaho doesn't specifically provide, other than there's a duty to repay losses at some point and that their funds are inviolate. So it is possible in Idaho that at some point payments, distributions would stop. That's not impossible under their system, although clearly they're banking for that with the size of their reserves.
Mr. Chairman.
But then what would you have to do with the loss makeup?
Okay, so under Idaho statute, the losses are required of their school permanent fund and are permissive for others. But according to our conversations, they haven't had losses that they've had to repay, but if they did, they would do it in this way. After 9 consecutive years of cumulative loss, and in the 10th year, then they have a constitutional and statutory obligation to start making payments. They can pay it all off at once, or they have to start paying off the first year where there were losses. So that gets them back up. That would eventually start building those funds again. Though, so what that really means is that you can have 10 consecutive years where you're drawing from the reserve account. It does not mean that there's 10 consecutive years of drawing from down the corpus, because their corpus is inviolate. And I don't think that would be permissible under their constitution.
Okay, so go ahead. Representative Larson.
Thank you, Mr. Chairman. Ian, I'm having a hard time understanding the difference between the gain benchmark and the benchmark floor. It looks like that language is the same.
Sure, it is, well, there are some differences in how you calculate it, but really the benchmark floor is, and it's funny you bring this up, because I think the way their system is structured, you don't have to state that that's the benchmark floor. And maybe that's your question, because if every year you take the value in 2000, you add all of the deposits that have been made, it doesn't have anything to do with fair market value anyway. I mean, it's a cost basis anyway for that fund. So if that's your point, what is the difference? I think it's a belt and suspenders approach. You would not have to state that there is a benchmark floor, because you're never going to drop that corpus value anyway.
It adjusts each year per the.
Correct. And it only goes up. I mean, there's no provision.
And that's what it says in each definition.
Correct,
Yeah.
right. And there's no provision in the statutes for the corpus to go down. It either stays the same and doesn't get an inflationary adjustment, or it goes up, but it does not go down. So I actually had the same question, but.
So, and then back to the 10-year thing, that sound a little bit like a 10-year treasurer's interpretive rule? No?
Yes, that's right. Although that's in their statutory law. The 10-year repayment
Right.
provision is in their statute. The interesting of the Constitution more or less says the school fund has to be repaid pursuant to losses that are defined by the legislature and in a method more or less defined by the legislature. And then for all other permanent funds, it's permissive to repay losses or not, but they've made the policy decision to statutorily require the payment of losses after 10 years of cumulative loss to that corpus fund.
Okay.
So, what we've spent so much time considering is then what about that as an endowment model? I think there's two things. As I've mentioned, all gains are scraped from the corpus permanent fund and given to the earnings reserve fund. And only then are they subject to expenditure when they're in the earnings reserve fund. What that means that in the calculation of what amounts are expendable and should be transferred to that earnings reserve, earnings, interest, and dividend is never considered. It's the fair market value minus that adjusted corpus value. You don't have to produce earnings and those kind of specific types of gains to try to justify your spending from the earnings reserve account. I think the second element that is important to consider is that the gains that are allocated to the earnings reserves fund and that then are subject to expenditure are any gains. They're realized or unrealized capital gains or any other funds that are available to them. They're fungible. And I think that's what our investment people are telling is the magic in this system, is that you get to pick from all gains to meet your obligations, not a specific subset of gains.
Ian, just to get an understanding of, they've got a fund that has 2 billion in it. Well, no, permanent fund of 1.17. Their earnings reserve is 700 million, right? So that's 700 million. I'm just trying to figure out what that typical ratio is or what they need in terms of distributions based upon the size of the permanent funds and as compared to their earnings reserve account.
I wish I spent a lot more time thinking about the structure of their system rather than what the amounts mean. But I mean, they've targeted all their funds to either 6 or 7 years of spending. Now, your question earlier about Utah, I don't know the answer in terms of in Idaho either about what percentage of the demand does that meet. I'm sorry, I don't know. We could find out, but I don't know. But that's the answer, is they've estimated that a 6 to 7 year reserve is adequate for their purposes.
And
That's based on our spending policy.
Sure.
What that reserve is, what 1 year versus 7 years.
Yeah, absolutely. Yeah. One thing I will mention is that, and somebody else in the room, I may be wrong on this, but the way I look at this is that one of the advantages with this vertical integration and all gains, including unearned gains, going to the reserve fund. And if you pool those investments between those two funds, not only do you have a reserve fund that is larger because it's got all the gains, including the unrealized gains. Right now in Wyoming, we have whatever the number is, $2.3 billion of unrealized gains. Now that may be distributed among more than one account, but the fact is under this system, that can be invested like it's a large amount of money because there's integration, all the funds, even if it's just in one fund between the permanent fund and the earnings reserve fund, that's a larger amount than doing it separately like we currently do in Wyoming, where you have the permanent mineral trust fund that can be invested, but that much smaller reserve account must be kept liquid because the funds can be demanded from that. Here you avoid that.
right. So when it gets down to what is what the treasurer's office knows is they know that in the coming year, they have to distribute, if the funding policy is 5%, they know they have to have cash to distribute 5%. They don't have to worry about cash and what else is in the reserve fund. They get to go invest for a total return on whatever it is, absent what they know will be the cash flow requirement for the coming fiscal year.
Chairman, that's exactly my understanding. We talked to the Idaho gentleman about that a bit, and he agreed with that. And the word he used is they're fungible, and you can get rid of those investments that are appropriate to liquidate to meet your spending obligations, and otherwise you can keep those that aren't ready. It'll give you better to hold. Interestingly, and I think Brian already kind of mentioned it, that this structure gets rid of I believe it gets rid of the Meyer rule because the earnings, offsetting realized earnings against gains is simply a matter of what is the fair market value of the fund when you're considering that entire gain. I think I already mentioned that there's the loss provision and a slightly different calculation of the corpus for purpose of determining your losses. The loss, what they call the loss benchmark or the corpus value, doesn't include an inflationary index in the Idaho model when you're considering losses. So you won't have to repay the inflationary index. It also doesn't include direct deposits from their earnings reserves. Because if you look at your chart that you have, you'll see that, you know, again, all money goes in here. This is only corpus. So all the money is in the earnings reserve account. And then funds can flow out of that earnings reserve account in almost every way. Part of them go to beneficiaries. Part of them can be retained within the earnings reserve account. That's what gives you the 6 to 7 years. Or part of them can be reinvested back to the corpus for purposes of, you know, either inflationary adjustment or further inflationary adjustment, or providing just a larger corpus for future beneficiaries.
So you've got in here in your double asterisk on the page. So when they have, you know, I was looking, you've got excess reserves flowing back to the permanent fund. And then down in your footnote, it says that these excess reserves or amounts in the earnings reserve fund above the management and administrative costs can be retained within the reserve, or they can be transferred back to the fund as a contribution to corpus, or can be transferred for appropriation or spending. So if they're excess reserves, did I understand you say that even though they're put back in corpus, they don't count as the corpus floor?
That's correct. They don't have to be counted. That's right.
Okay.
You don't have to include those in your loss ratio if you're considering what has to be paid back by the
So
legislature.
in doomsday scenario, you don't count them, but for almost every other purpose you do.
That's right. Correct. It's interesting. I thought about this morning when I was reading about our permanent mineral trust fund, and our new constitutional language says deposits to the fund from any source. So Wyoming couldn't have that provision in its permanent mineral trust fund because they are automatically part of the corpus value in Wyoming. Yeah, so that's one thing that would be required because, yep, if we wanted this exact model, that's right, because otherwise they would have to be counted in the corpus value. Let me make one other comment just because we're here. On that chart, you can see these two boxes in the bottom. It's interesting that under the Idaho Constitution, they actually require that the administrative expenses be paid from that reserve account first and before any other distributions are made. It doesn't, you know, we talked about, you know, how you pay for those, whether it's a basis amount or what it is. They don't make that clear at all from their Constitution or statutory provisions, but nevertheless, they do provide for it, and it has to happen first from that earnings reserve
So we
account.
need to- When they established this process, did they amend their constitution?
They did substantially, yeah, and their active admission.
That was when?
About 2000. They started in about 1998 making a lot of these changes, which is another discussion to have is well, why'd they pick the year 2000? And we asked that question. The gentleman we talked to wasn't there in the year 2000, but it seems fairly clear that it was just a matter of practicality. You have to pick a date. And that was about the time they were performing those functions, and that's the date they picked. You know, clearly you could try to determine what the cost basis is and just flat state it in the statute that the number is this, and you add every year. I think one thing that this committee will be faced with in determining what they want to establish as the basis is to frankly not try to capture all of our unearned gains, because otherwise that gets wrapped into a corpus, it becomes unviolent, and we don't get a lot of the freedoms we were just talking about with a larger reserve amount that can be invested for the longer term.
Representative Larson.
Thank you again, Mr. Chairman. So Ian, I try and adapt their model to what I'm used to in ours. So their reserve account just doesn't tip. They can take money from the reserve account if they elect to grow the corpus. But like our severance tax, there are things required to go to the corpus, would make land sales, whatever that may be. But then the reserve account and the corpus works together, working for investment, and any interest generated off that amount of the reserve is then reserve income and is not inviolate. It can be So it grows and can be spent as well and isn't attributed to the corpus. Have I got that right?
Mr. Chairman, Representative Larson, that's correct. It's, that's exactly that's the effect of it. It's a little more complicated in that all of the funds are actually pooled together and that they each get their proportionate share of the earnings at the end of the year. But that's correct. Any of those that are specifically attributable to the earnings reserve account, they can be distributed. However, consistent with their policies. On the other hand, everything that was all the earnings that were in the corpus account must be then transferred that year to the earnings reserve accounts.
Okay. Okay.
Yeah, even though they're pooling them, do they have different payout amounts for different funds? For example, if we take our pool A, essentially that's a low income producing account. And so it's not going to earn the same type of return. So are they imposing, allowing, so if we did this with pool A, would we keep a lower return on that investment in terms of distribution, or would we have it whatever it is? Or can we adjust it to however, depending on what the purpose of the fund is?
Right, Mr. Chairman, Representative Nicholas. My understanding is that when you talk about these 9 permanent endowment funds that operate under this model, no, they're all invested the same. They get the same returns. Now, certainly they do have different distribution amounts that go to each one depending on their beneficiaries. But no, otherwise, my understanding is that their funds are completely pooled and the earnings are all considered together. And then again, it's just a pro rata share of each balance that determines the amount of the earnings that they get in any year. So it's simple.
Okay.
Mr. Chairman, I guess I'll just point to page 2 and 3 of this. Is again, I'm going back to the model, the Idaho model page. What I tried to do here is just one of the decision points that this committee needs to make if they want to pursue this kind of an option is to just determine what you want in the Constitution and what you want in statute. And I won't go through this in detail, other than the things I haven't read are constitutionally created. They may also be duplicated in statute, but they have a constitutional basis. And all those things that are in blue are details that are provided by statute. So in Idaho, it kind of, I think it's fairly detailed constitution, but it does leave a lot to statute. But unlike, for instance, in Utah, where they actually set a spending cap 4% in their constitution, Idaho does not do that. What they do in the Constitution is they establish the funds and then fund them, primarily through lands that came through their active admission. They make those funds inviolate. They importantly do establish this 2-fund vertical structure where you have a permanent endowment fund and you have an associated earnings reserve fund with every one of the permanent funds. And then it constitutionally established that all earnings from that corpus fund or the permanent fund are transferred to the earnings endowment fund. So that's all constitutionally based, and those 2 funds are constitutionally established. It makes, as I think I mentioned, it creates a duty to make up losses, at least for the school permanent fund, but then all the other funds follow that. And then, as I mentioned earlier, it also provides for those administrative costs to be paid first out of that earnings reserve fund. All the other things are established by statute, other than, as I said, they've chosen not to adopt a specific spending policy in either their statute or constitution. I think that really we've talked, incidentally about the other points I wanted to make about Idaho, the benefits of that model where all gains are transferred, it frees them from interest. And the fact that it provides them larger pools to invest through the integration and the pooling of both the permanent fund and the earnings reserve fund, let alone the other 9 pools that you could have all pulled as one. But even within each vertical category, they do have a larger amount of assets to pool together to invest. And then, as I said, I think it's important to recognize that although there are 10 years of cumulative losses, at first to me at least sounded a little startling. The fact is that there are still being payments being made out of the reserve accounts, and that does not mean that they're violating their corpus for those purposes. So, Mr. Chairman, I think that's the Idaho model. From there, I think it points to a lot of decisions that this committee would have on how they want to go forward. I do think that, if it was the committee's wish to have LSO draft a bill that basically brought us into the Idaho endowment structure, at least for, something like the Permanent Mineral Trust Fund. I think we can do that. I mean, I think that this exercise has brought us a lot closer to understanding what that would need to look like. There are a number of changes. I mean, I anticipate one of the questions, does there have to be a constitutional amendment? Brian and I have talked about it at some length. We've looked at what other states have done to their constitutions to accomplish what they've done, and they have amended their constitutions to get there. Now, for reasons we don't fully understand, Utah just chose one to not amend its act of admission, but other states have, and I think that there are some arguments that would be in favor of that clarity. And Congress seems to, at least thus far, been very willing to do it. It doesn't seem to have been a big struggle, and it's been fairly quick. But I think the act of admission came first in Idaho by
Yeah.
about a year.
Yeah, Mr. Chairman, they amended their act of admission in 1998.
Passed in 2000.
And then I've got another question for you. So I'm trying to understand this. They've got a separate down. So I mean, you can kind of consolidate all those.
Mr. Chairman, my understanding that is what they did, and although that took a very long time. So this process, I've got a document, I didn't disclose it to the committee, but I've got a document that where an attorney with their AG's office summarized sort of their process and what they went through. And I believe it starts in 1983, I think. And that's exactly what they were looking at back then. They weren't happy with their timber sales and how they were being administered or applied. They invested in a bunch of commercial real estate, and there seems to be some hubbub about that because that was a big discussion for a number of years of how they were handling those. And that was the result. I think these changes we're talking about came at the very end of that process. I think after they had those investment activities wrapped up.
Mr. Chairman, thank you. Ian, I had to step out for a minute. So if this has been asked and answered, forgive me, but in Utah and Idaho, are they prohibited from doing what we commonly do in Wyoming, which is we intercept or divert the backflows into the funds? Are they prohibited by Constitution from doing that? That is that all the earnings go into the fund and money only comes out constitutionally when it goes to this earnings reserve fund?
Right. Mr. Chairman, Senator Ginsky, yes, they are, particularly for that first transfer. I mean, it is very clear.
If you look at your chart, the only thing that flows back into the permanent fund are excess reserves.
Right.
And is that by formula or is that by legislative decision?
It's interesting. That's by land board policy.
The
apparently.
land board policy does that. So
Correct.
so it doesn't happen automatically. There's no
Correct.
automatic TIF.
Right.
The land board decides when and if they're going to take money out of the reserve fund and put it back into the permanent fund. And
Right. But then what I think maybe we're on the same page, because what I meant to say is that particularly from the initial transfer of gains from the permanent fund to the earnings reserve fund, that's constitutionally required. And so I think there is no intercepting those funds. Once they're in the earnings reserve, it is interesting. They have a constitutional provision that says the legislature cannot appropriate from the earnings reserve fund, but except for the purpose of administrative expenses. And then, I mean, we're getting into some minutiae here, but then the Constitution and the statutes talked about spending accounts. And yet when I asked them that question, okay, well, tell me about the spending accounts, their answer was, we don't use those.
So how do they get money out of this? Let's just make it easy. Let's say it's this common school. How do they get money to the schools? The land board simply appropriates it. Or
Well,
not, the land board makes a distribution.
no, I think what happens, although, but it's just, this is kind of Brian's situation where your specific questions just aren't handled in their statute or their constitution. But I think what happens clearly, that the legislature in Idaho still appropriates funds that have been determined by the land board to be distributable. But those, once they determined by the land board to be part of the earnings distribution from that fund, then they are appropriated by the legislature. And that's ultimately the answer. The legislature can do with whatever it wants with those. But it does appear in Idaho that the land board has a much more significant ability to control what those distributions are.
Mr. Chairman.
Yes.
So for instance, in Idaho or Utah, can they do something like intercept all capital gains over a certain percentage and allocate them to a bunch of capital projects over a 4-year period? Or does those capital gains have to flow back into the permanent fund?
Sure. Mr. Chairman, that specific idea, because you're only talking about one type of gains, for example, would be difficult under this endowment model. Yes, you could intercept funds that are in the earnings reserve account from whatever source. But to say that, like, we have to here where they're a certain kind of gain, we wouldn't have to do that. But yes, I mean, ultimately you could accomplish that purpose, because from an earnings reserve account, if it's an amount that is released by the land board, it is subject to appropriation by their legislature. So you can do with it what you want.
And the land board is basically their version of our SLID.
Correct. That's right.
But then you'd add the director of the Idaho, what's the director of IDL?
That's their investment. I'm sorry, I don't know what that acronym is, but that's.
Anyway,
their
so you've got the superintendent of public instruction, you got the state controller, the attorney general, secretary of state, and the governor.
I think, Mr. Chairman, I think IDL is their Department of Lands. So I
Department
think
of Land.
it's
So it's,
probably the analog would be OSLI.
oh, so the governor gets 2 votes. Okay.
So, Mr. Chairman, Idaho does not have a cap like Utah of cannot exceed 4%. Idaho is, they take out of that expenditure reserve, whatever they deem appropriate, and pass it on to the legislature.
Mr. Chairman, I believe that's correct. That's right. The corpus remains inviolate. So the corpus, you're not going to be violate for that purpose, but that's right. Any of the gains above that would be subject to.
Cost, inflation, all that.
Correct. Yeah.
Pretty honest.
Okay. All right. So Ian, does that conclude your?
Well, that does, Mr. Chairman. And I guess the question for the committee is, I mean, that brings up a lot of decision points, which I have kind of an outline of them, but I mean, I don't know that it's worth going. It's like, does the committee, if we're going to draft a bill for the committee to consider, do you want to maintain the inviolate nature of our funds? I assume that we want to go to this endowment model. How do we want to define earnings? One thing that LSO can do is produce Wyoming a more or less Idaho model using our current spending policy. It gets a little difficult, as I've mentioned, because our permanent mineral trust fund already has it's got diversions that are different. I mean, all the money goes constitutionally into the general fund, not into a reserve account at all. That creates, some potential issues because you don't have this nice pooling of 2 funds like you do. So, but I mean, that's something that we could also present to you in a constitutional amendment, because it also it mentions income, not earnings or not gains. And so I think it's the opinion of LSO that it would be the safe route is to make that constitutional change like other states.
So Ian, have you thought about it for simplicity's sake? If we do this in a test model, would it make more sense to do this on the common school account first before we do the permanent mineral trust fund?
Actually, I'm thinking it makes more sense to do on the permanent land and the PMTF. And the reason is that I think that you can find some workarounds in statute. For example, if the earnings from the PMTF don't go to the general fund, they're required to go to the general fund or the Constitution. But if you wanted to, you could make an auto appropriation out of the general fund and take care of that. So I think there's a workaround. Where I don't think there are workarounds in the common school permanent land fund. I don't think you can go down this road on the common school permanent land fund until you change the Constitution for a number of reasons, because it pulls out interest and royalties and lease rents. And so we've got those things are directly in the Constitution. And so I don't know how we work around those in the common school permanent land fund. But to take this, I was thinking though that that's exactly right. That what I think would make a lot of sense is if we start with the PMTF, and we did this to the PMTF, and in that you identify through this exercise, we'll identify those changes need to be made to the Constitution. Because not only do we have to do the obvious ones, but maybe you want to take in, maybe you want to put in a 4%, or maybe you want to put something else in that. And so, I think you kind of have to do this together, but I think going through this process will help us identify that. What I'd like to do is what I would recommend that we do, and I'll throw this out to the committee, was that we pursue down just what Ian just said, that we take the PMTF and start to see if we can do their version of the Idaho model, and that we pick a working group out of this group to kind of then go, that'd be kind of the starting point. And then you can take that and work that and see if we can get something done in time to refer this back to appropriations, so that we can, if we wanted to take it up and have a hearing on it, we could do that before we finish the budget in June.
Mr. Chairman, you started a sentence that you didn't finish. You said in the PMTF, the money has to go to the general fund, but we could have a workaround. Then you never said what the workaround was.
Workaround is you have an auto appropriation for the general fund, whatever that amount.
Auto appropriation, what?
Out of the general.
Automatic appropriation of the general fund money, that then puts it wherever you want to put it.
Mhm. And then, Mr. Chairman, I want to make sure I'm understanding an endowment model. If you have an endowment model and you're just going to peel off a constant 5% every year, why do you need it? Why do you need a reserve fund?
Well, the only reason you need the reserve fund is you have to segregate your corpus from the other money that's available. That's the only reason. And whether you call it a reserve fund or whatever, we can call it whatever we call it, but ultimately that's, until you have that, it's basically an accounting device to make sure that you're not intruding on corpus.
Yeah, and it's a protection against losses.
And Mr. Chairman, then would the reserve fund be constitutionally protected from appropriation by the legislature?
Well,
version?
I think that's one of the things we would consider. I don't think and we say constitutionally protected, the PMTF is constitutionally protected now. And so the question is what do you change in the Constitution with respect to the PMTF? And those are good questions that I would hope the working group would come back. Because like I say, going through this exercise, if we wanted to try and move this Idaho endowment issue, that gets us a long way down the road. If we do it, we're doing that with the largest endowment fund that we have. And we have the ability to start to make that impact sooner if it goes long and it turns out it's a good idea. If it's not a good idea, then it won't be a good idea. We can't get it done. No, I think that'll help. I think this will help flesh it out. And to the extent if we have to do it, like I say, I'm pretty sure we have to do it for the permanent land fund. I'm not sure that you have to do it for the PMTF, but we'll find that out. Go ahead, Gary.
Yes, Mr. Chairman, the reason you don't need a reserve account is because you have on the front end of the transaction, you have a holding account, which is holding basically total income. And then you're distributing your spending policy out of that. So there isn't any need for a reserve.
Right. It's just a name.
So, Mr. Chairman, as you talk about the permanent mineral trust, Mr. Chairman. Oh, I'm sorry.
Were you speaking? You were helping.
No.
Oh, you're telling me to go to Larson.
Ladies first, please.
No, she's saying to go to you. She's helping me. She's helping direct
you.
traffic.
So, Mr. Chairman, you talked about the PMTF maybe starting on that road, but yet on the school side, to Representative Schwartz's point, we've got that active admissions and then a constitutional amendment. So is that regardless of what we do on any of this stuff, the active admissions component and the constitutional would benefit us adjusting that language. So is that something that we could be working on at the same time as we're working on the PMTF?
I think so, but the idea is that as you do that, if we get to the PMTF, there'll be a bunch of that that'll translate to the Common School Permanent Land Fund as well as any of the other permanent funds. And so if you do that, I think a lot of that'll fall out. But at the end of the day, I don't think we want to go back and have our active admission amended twice.
Fair.
We want to, by the way, this week, Congress, we would like you to do this for the little state of.
Tell me how that works. Tell me how that works. Does that go back? Congress does that for us or?
Yeah, you go ahead. I bet Brian knows more about this, a lot more about this.
Okay.
than I do.
Yeah, Mr. Chairman, first Representative Schwartz. The change to the active admission doesn't contemplate the permanent trust fund. So there would need to be no change to the active admission to enact changes to the permanent trust fund. It would only be the common school account, the permanent land fund, that would require a change to the active admission.
Well, you have to check. I mean, because keep in mind, there's also, I think there's a couple others. There's a couple other constitutional land funds that we have to be cognizant of. So, because I think the penitentiary's got a land fund, doesn't it? And the miners hospital, we don't have a land fund, we have a corpus now. And so there's some of those things.
And we want to add those in because some of those funds need to go.
Yeah, and Mr. Chairman, that would all be captured within, I guess, what I would call the permanent land fund. You know, there are all those separate accounts, you know, the miners hospitals, state penitentiary and so forth. That would be captured in a change to the active admission.
And with respect to the universities, they do their own, don't they? Don't they manage their own, or do we manage that?
Mr. Chairman,
University, I think they do I think they do their own thing there, so.
yeah, I think that's at least in our active admission, that is a separate section
Okay.
that addresses that fund.
So finish your thought. Did that finish your?
I have new thought.
Oh, you have a new thought. Okay, go ahead, Representative Schwartz.
Thank you, Mr. Chairman. So going back, so the reference in the Constitution on the permanent mineral trust fund is to income. And we know that's a problem because income and earnings are different. And just correct me when I go wrong.
Yeah, well,
they might be different.
They might be different. We've been
Could
going
we-
how many years now where we haven't?
Right. So what, I guess my question is, but we've never defined the difference. Could we statutorily define the difference between income and earnings and therefore avoid the need to change it constitutionally?
We did that last session.
Did I miss that?
No, you were there. You voted.
That's not what I said.
But that's a good point. I mean, at the end of the day, if you're going to clean this up, you clean it up. You clean the whole thing.
Yeah, I'm sorry, I'm getting old. My memory's just. I voted yes.
I think so. You guys passed it. It was 121.
No, I'm sure it was.
And so, and with the working group, we want to make sure we include the treasurer and his group in the working group discussions. So while we're on that, does that make sense for the committee? So, all right, so who wants to be on the working group?
Why don't you appoint your house, Senate guys, I'll appoint.
Okay, you appoint your guys.
How many do you want on it?
Isn't it constitutionally required to have a Democrat on the committee?
We will. How many you want? 2?
2 and 2 or 3 and 2?
Constitution should be at least twice as large.
That's a good point. Larry and who's the other one?
You. It's easy.
Okay. Larry and Drew. My brother's named Larry. Anyway. Larry and Drew. That'll teach Larry to miss a meeting. Yeah, all right, Larry and Drew. And, okay.
Yeah.
And so I think that takes gas. So let's go back to 244.
Okay.
Let's go back to 244. On 244, what I would suggest is that we would take and do, Brian, I think in looking at this, you're familiar with the outline that we got today. Between you and Ian.
Mr. Chairman, with the caveat that we've, had as much time to review it as you have.
Yeah.
So I mean, there's some familiarity, at least with the report, yes.
So I think what I'd recommend that we do is we just kind of put together a high level, we put together a draft bill that incorporates the general provisions of the report that we've had with respect to moving the IFC into a board. And then I don't think we get down into the CEO. We don't get down to the CEO or don't go. I don't think we know enough about that yet. But I think that we start to go and look, at least put the bill together, because I think we all discuss and work better once we have a bill in front of us. And so I would suggest that we take the recommendations from the IFC with respect to independence. I don't know, and Mr. Treasurer, I don't know what on the independence with respect to budgeting. I think that what I think we would do there is we would have the treasurer's office make a recommended build out of where that needs to go, Mr. Treasurer. And then I think what we do is, we just, as a general guideline, we'll leave it blank now, but it's just going to be, he puts together the budget, but we want to have that backed up by, so many, we can leave it blank for now, but a certain number of basis points. And then we'll work on that. We can get that to come together as we merge and figure out exactly where that's going. But at least get that far.
So would we want the IFC to comment on the structure in terms of accounting staff necessary, what they believe will be a executive secretary, obviously, and or a COO, CEO, or whatever they think they will need, and then have to kind of cross-pollinate that with whatever recommendation the treasurer.
Yeah, I mean, it's ultimately, we've got to know what the build out looks like, and we got to figure out the price. We got to figure out and then we can translate that back into basis points on the portfolio, and put an upper limit on that. But I don't know how else to get that. I don't know how else to get that together to get the budget independence that we're talking about together on this thing to do the build out. I think you kind of have to work out them both together and figure out where they'll meet.
Josh, do you have any thoughts on this? On initial construction and manpower? I mean, and then put a dollar sign on it, and then interpret that, extrapolate that into basis points, and then they'll construct a budget after that. What was your concept, or if you have? Yeah, Jim. He's behind the post.
Jim's behind the pillar. He's
Yes, we have actually talked to a number of the peer funds.
Come on up and speak on your phone, because I think Helen, may still be out.
Mr. Chair and members, we have talked to a number of the peer funds about the process that they go through. Your neighbor to the north, Montana, for example, has a budget limit of a certain number of percentage points, basis points on the funds. And then they construct the budget that is reviewed, and it has to stay within that. But my colleague Josh is exactly right. What is the process first for building the number up and deciding on it? But then the other issue is, well, what is that number? And what is the number is based on exactly what duties and responsibilities you give to this new organization that you're considering. But the process by which any budget is approved for them is something that is typically would be put in statute itself. I hope that's helpful.
I appreciate that. And my thought is really, as we're talking about that, I think when Don was talking earlier, I mean, they're already working on the build out of the back office and things like that. So I'm talking about that as well. And so I'm trying to get to this point where this is a budget session. We're going to come out of this at the end of February or first part of March with the budget. And at least the initial phases of this have to be in that budget. And so it's not just the governance and the cost of governance. I think that's the smallest of all the expenditure. The bigger expenditures over here in the mid office and the back office, we start to build out that support function. And so we've got to work on all these ends coming together at the same time.
If I could, Mr. Chair, members of the committee, I think you're exactly right. This is what I was referring to as what responsibilities you give to this new organization, what responsibilities you might leave with the treasurer's office. And the peer funds differ on that respect. In the case of your neighbor to the north, Montana, they are all in the separate organization, the Bureau of Investment, they call it. In the case of, it's not one of the peer funds, but they are going through the same process you are. They're starting off with a memorandum of understanding of services that the treasurer's office would provide to the independent entity. And that process, the treasurer's office would go through the budget office or budget process. And the independent entity would fund only investment expenses, and those would come out of the funds themselves.
And that's Montana?
That's Vermont, actually. I should have been clear about that. And by the way, I believe Florida works somewhat the same way.
And I think our goal is, at the end of the day, the back office, mid office, and front office, regardless of where that is, that's all going to come out of the investment stream, out of the investment earnings / income / differential.
And Jim, how do the different entities that have an independent body compensate their board members?
It typically in the US, there has not been compensation, but compensation is starting to creep into the discussion. And part of it is because exactly the conversation that you have had about HB 244, the desire to recruit in with investment expertise that is committed beyond, I don't want to use this in a denigrative term, but as a hobby or a favor to the entity, but actually roll up your sleeves and do something. So I mentioned Vermont. Vermont just went through the process that you went through, and they decided to pay their chair. In the case of, we have another client that's a public of $20 billion plus public health workers' comp insurance plan. They reconstituted their entire structure, quite frankly, because of a scandal that occurred 12 or 14 years ago, professionalized the board, all outside members, and they are paid like a board of directors would be on a corporation. So that is something that is starting to creep into the US. We see that somewhat more often overseas. It's totally up to you as to how you want to incentivize any members of this new investment board should you go ahead and create it. And I'll stop there.
And I think I saw in the report, it went everywhere from like a per diem like we're doing now to, I think the chair was getting, I think the members were getting 49 and the chair was getting 190, something like that, about twice that. It seemed like, maybe I remember wrong. But I mean, it's in a, probably there, and that's the high and the low, and we can be somewhere high, lower in between. Okay.
Anywhere else I can help you?
Mr. Chairman,
Go ahead.
just a question. Why would you not ask for a bill draft that just tracks what the IFC's recommendations are?
I think that's what I just asked.
Well, what I heard you say is you wanted to start with what a build out was first.
We're trying to do both.
Okay. But, all right.
No, go ahead.
No, they said they needed to know what the structure was before they could do the build out. I thought you were asking for the build
Well,
out before the structure.
It's got to happen. It's going to happen together. There's two build outs. There's, if the IFC becomes becomes the board, there's a build out there, and that's not a very big build out. That's your IFC with some compensation. That's going to be, then I think they have 1 or 2 employees is what was in the recommendation. So that's a pretty minor build out. The big build out is is what the treasurer's office is doing right now, which is the back office and mid
Middle
office.
office, back office, sure.
So how do we fully segregate the two from the treasurer's office, if indeed we do, or if we do a memo of understanding while we're in the process of the build out? I mean, because we don't have that information and
That's exactly what the legislature in Vermont and the executive branch decided to do for the first year. The independent entity opted to do a memorandum, which they're negotiating right now with the treasurer's office. I would defer to the treasurer on this, but my understanding and Josh's understanding is that there are parts of the treasurer's staff right now that are compensated from the funds themselves and not from the general fund. So that ice has already been broken to in some respects. It's just not clear to us because the treasurer's office has a multitude of tasks, exactly how many FTE are associated with it, but the treasurer may have that number on the tip of his tongue.
I don't know if he does, but between he and Don, they probably do. So Mr. Treasurer, did Jim catch your comment?
Mr. Chairman, excuse me for jumping in here. I did want to just clarify, my understanding of the IFC proposal is not exactly what you stated with mid and back office in the treasurer's office. Their proposal is an independent investment office that is under the IFC board as a separate agency. And that includes front, middle, and back office.
yeah, I think we understand.
No, I think we understand that, but it's going to be, I mean, regardless of how it starts, regardless of where it ends up, it's got to start out. It's not going to start out where it's not going to start out from day one. We've got to do the work while we build the house. And so, hopefully it doesn't end up like the Winchester Mansion? Is that the one that's got this hallways that go nowhere? We don't want to end up like that, but initially it'll be a hybrid regardless of how it ultimately turns out, I think.
Yep.
Yeah,
Mr. Chairman,
and this is just a build draft, and it'll help us focus our thinking.
Mr. Chairman, if I may, in our report, which I understand you didn't get till this morning, but if you have a chance to read it, we did in our study of the peer funds do quite a bit of digging into what their operating costs were as a percentage of their assets. And I would frame it, and I would offer this just as hopefully sort of helpful general guidance on where these funds are as far as basis points. There's a group of funds, primarily US, where there's very little budget and human resources autonomy, much like as currently exists in Wyoming. Those funds, and I believe we calculated Wyoming's operating costs for the investment function somewhere in the 1.7 basis points. Most of those funds, and you'd find Idaho, New Mexico, Alaska, actually all still in that range, about 1.5 to 2 basis points. On the other end of the extreme, sort of the fully built out professional asset management company, which you really only see at Alberta and New Zealand among the peer funds, they're anywhere from mid-teens to 20 basis points, but they have a lot of external legal expense. And in the case of New Zealand, their funds are taxable. So there's a lot of tax advice and external tax counsel. There's a group of funds that I think provide a little better perspective on where this may be going with moving, more towards a built-out professional investment board and office. I would point to Wisconsin, Utah's school fund as two examples of that. And I believe in there you find kind of the 6 to 8 basis points is sort of for that second category of expenses that Don O'Patroni described, staff expenses, rent, systems and tools. I think that's at least hopefully some helpful information for where we see that with the peer funds.
Okay, thank you. Appreciate that. I think we get that. I think we also have the WRS, the retirement system kind of, it's not exactly the same, but it's not dissimilar either. So, but I appreciate that. And we'll take a good look at the expanded report and dig out some of those details as well. But ultimately a lot of it will come down to I think what the treasurer and his staff do as we do that build out, particularly in the back office and mid office. I think because we've got a lot of the front office already there. So as we get that, we'll figure it out and we'll find a good number. And I think that number, I'm hoping that number somewhere below, we're in that 10 or so, 9, 10 is kind of, including all in costs, but we'll see where it goes.
Mr. Chairman, I think a way that we might be able to move forward on that, especially if it's, if you guys are actually considering the independence of HR systems and processes, is to essentially authorize an authorization of 10 basis points, and that the treasurer's office in consultation with the ISC would look at, I guess, a staffing recommendation to go forward over the next 2 years. And that should get us to a tipping point where we should have some kind of hopefully from my perspective, a compromise that gives some independence and some operational independence and some budgetary independence. I can't remember which, it might be Alaska. They don't have any restrictions on the positions or what the positions do, but they do have restrictions on how much money they can spend. And so they actually make the determinations about, what people they hire, what job classifications they are, and they're not subject to the other HR and procurement requirements of the rest of the state. And so that's what you get when you have an independent, I guess, more or less instrumentality or whatever it ends up being, because they aren't subject to the other state, I guess, structures, but they are subject to, a cap on the amount of money that is spent. So
yeah, and I think we're saying the same thing. We just, we start that discussion in earnest tomorrow. And as we, this is just a bill draft. And so by the time we get it down to the end of the bill draft, and as it works its way through the process, if it gets through the process, is we'll be able to figure out what that number is, and whether it's 8 or whether it's 10 or whatever that number is, we'll come to a number. Then I think that we'll all be a little uncomfortable with.
Yeah, I think err on the side of overfunding, but what I would do with the overfunding is that I would put it in a separate holding account that would be invested in the same manner as the Permanent Mineral Trust Fund, and any interest or income off of that would be distributed to the general fund. So there wouldn't be any necessarily loss to the budgetary system if we erred on the side of too much rather than erring on the side of too little. I think a lot of the positions and the job classifications and their duties is going to be determined by the skill set of the people that we can source to fill those upper level positions. And from what I've seen, that can go from those positions, and I don't think we'd ever hit the high point, but I think Alberta's CIO or CEO was $3.1 or $3.4 million a year.
It's good work if you can get it.
It's good work if you can get it, and, but the baseline on that is probably 300 to 400, which is kind of average. But, and I'm not sure on COOs, I think we've probably have not really sourced a level of talent because we've been very restrictive on our salary structure. But I'd like to be able to get at least the same level of talent in the operational side as we have in the investment side. And as you say, don't forget the WRS. They've got their own means as the liaisons can do
We'll
that.
get there. I mean, we'll figure this out. And I mean, at the end of the day, I don't think we're going to go over a couple of basis points. So not when you got as much at risk as we all do.
Yeah, 10 basis points on 25 billion is, it's a lot of money, but it's not a lot of it. It's a small number.
I just, this is probably an obvious comment, Mr. Chair and members of the committee, but should you go down the road to create a focused investment-only entity for the state of Wyoming, one of the advantages is the clarity with which where dollars should legitimately come from. If they're doing nothing but investing Wyoming's funds, then being funded completely from Wyoming funds separates them from any sort of confusion about whether general funds are needed or used or whatever. And I know from experience in state government myself in Oregon that can be a source of contention, argument, and confusion. So that this is a potential opportunity to have complete clarity over where dollars come from for what particular activities for the state of Montana.
Yeah, and all your funds just share ratably in the basic. I mean, they get this basis points off whatever they've got. So yeah, I get it. I get it.
Mr. Chairman?
Yes.
Can I just chime in real quick? I just want to assure you that as you all well know, I have a budget background of, oh gosh, how many years? Almost 20 now. So you can rest assured that I'm going to give you a good number as I work through this process with you and the treasurer and the staff. And I also would like to add that I think that we have a fantastic group of people in the treasurer's office right now. And a lot of this conversation talks about we need to get the best and the brightest. And I think you're getting a really good bang for your buck right now. So I just want to put that out there. Thank you.
Thank you.
Yeah, Mr. Chairman, there's, from where we are to from where we were to where we are, I can't say anything bad about any of the crew. They're on all sides of the equation. They're doing a very, very good job. And
Which thank you for bringing that up. And you're right. We appreciate our, your employees work hard and they've been under a lot of pressure the last couple of years to, get fixed problems that weren't their fault necessarily. So, but with respect to that, what you did say that you have the new back office accounting software. Did I hear you say earlier today you had selected a vendor? And has that gone out for have you already selected that, or are you working on the contract now? Can you disclose who that is to us, or is it too early to let us know?
No, Mr. Chairman, we're upgrading our current system. So we're staying with our current vendor. But it's Broadridge Financial Solutions. The system hasn't been updated since approximately 1993. So they actually do have a lot of functionality that the state has never taken advantage of and have a really good sense of what our needs are. We've done a lot of work to identify those things. We've done side-by-side comparison. As you know, we're pursuing a relationship with Clearwater. And at the end of the day, when we did our due diligence and put it all down on paper, the best route for us to go is with Broadridge. And so that is right. That's what we're going to do.
So just to follow up on that, and maybe you can provide us some more specifics in JAC, but what we'd like to see is a breakdown of how you get from A to Z. In other words, what all is going to happen between now and July 1st in order to be up and running with upgraded Broadridge, and in terms of staffing, training, software, hardware, what all that's going to take and what your timing is. Have you put together like a timeline scenario and all that kind of stuff?
Mr. Chairman, absolutely. I have been very clear that I'm not allowed to fail. And we
Nor
cannot
are we.
fail. I don't like coming to you and telling you that we're behind, or that we don't have a system yet, or that we're working on it. So I have been very clear about it. But yes, that is we have been nailing them down on this timeline, on requirements for training, a parallel that we're going to run parallel systems, because we will be running a parallel during one of our busiest times of the year in May and June. But it's a good time to do that because we have to do multiple iterations of distributions. It's a month-end and a year-end process. So it's a great time to run parallel. We'll be able to identify many, if there are any bugs, this will be an opportunity for us to really identify those. And then we will add modules after the first of the year, so that we will do enhancements basically that we've already planned for. But in order for us to get ready to go live on July 1st, we do have a plan. We've been back and forth negotiations, and I'm supposed to sign that statement of work on Friday. So
You're close.
mhm.
Okay.
Thank you.
Thank you. Look forward to hearing more from you tomorrow. So members, anything else? So let's go back to Brian and Ian. Have you got what you need from us for now?
Mr. Chairman, I would like to ask about the House Bill 244. And I just want to make sure that we're clear on our marching orders. So we're going to draft a bill based on the recommendations in the IFC report, which is to create an investment funds board and then a separate office to oversee accounting or investment functions. I just want to make sure that's what I heard as well, was that the current investment funds committee would basically transition into that new board. I just want to make sure I'm understanding that correctly.
That's correct.
Yeah.
Okay. Thank you, Mr. Chairman. The next question I have then would be, this new office, the scope of its duties, and specifically, I assume they would, oversee the investment of permanent funds, the larger non-permanent funds, but there are numerous places in statute where there are separate accounts that say the state treasurer shall invest this account in accordance with law. Is the intent that all of those investment functions would roll into this new office and board?
I think you gotta identify each one of them, because some of them may and some of them may not.
Okay.
For some of them, all we do is operate as a bank account. And whether they would fall into this major conglomerate of funds will be.
Yeah, if they haven't elected into pool A or pool B, I don't know that we would.
Okay, so we'll prepare that as a separate list. And then, Mr. Chairman, I know there's been a lot of discussion on funding. My kind of understanding of that is we'll just have a placeholder to kind of fill in a blank. And I think there will be more details that have to be ironed out, both in terms of initial and subsequent funding. But we will just kind of leave that fairly.
I think
open.
right now it'll be a lot like what the treasurer just said. It's going to be not to exceed. It's going to be a number not to exceed, and it'll be X number of basis points. I don't think we're going to we won't get very prescriptive about that. We just recognize that at the end of the day, we're going to be looking for this investment function to operate within a
Structure.
it's going to have its budget that is going to be subject to an overall limit, but they're going to have a tremendous amount of flexibility inside their pay bands and their employees and what they do. Yeah, and I just think in statute, we'll just put a number in there as the basis point number, and it'll be, if it's, we'll be able to adjust it up or down as
it's presented.
as we go. And initially, I think you're exactly right. I think it's going to be important to err on the high side. We want that to hamper, but we'll be talking a lot more, and we'll be doing this again in the interim budget to see if we can continue to make sure it works right. Okay. Okay, and then I guess, since I've counted up, we've got 7 members of this committee that serve on the Joint Appropriations Committee. So so then I guess we'll refer that, and we'll actually take, so then I think what we want to do is refer that to appropriations and have appropriations committee to work that, so that hopefully we can get these bills in a form that we can get them to the legislature in time for session.
Of course.
No. We have. Yeah.
So the alternative.
It's us or
Basically, we cease to exist in January.
Yeah, we don't exist after January.
So unless we meet between now and the end of December.
Okay. So with that, then, so that takes us back to our letter. So now can you fill in our interim work letter with the work, what we've just done? Polly?
Mr. Chairman, that is a good question. I think what we could do is maybe take a motion from the committee to allow that report to be finalized between staff and the chairman. But I would envision that would, at the beginning part of the memo, basically, as the committee has already voted, specify no changes are being recommended to the spending policies themselves, but then at the end, talk about the committee heard extensive reporting about different structures for investment offices in different states, and that they are preparing some legislation for that, as well as preparing, a possible constitutional amendment that will be referred to the Joint Appropriations Committee, something along those lines.
Right, it won't just be constitutional amendments, but to move investment towards a total return, I think. And so it's not just constitutional, but it's constitutional and statutory requirements to move it towards a total return.
So, Mr. Chairman, I would move that we direct the vice chair and chair to sign off on that letter when it's finally drafted.
Okay, discussion. All those in favor say aye.
Aye.
Those opposed, no. Motion carries. All right, what else have we got? What else have we got to do today? Yeah. Nothing? Okay. All right. Anything else from the body, from the committee? All right, thank you for your attendance. Thank you for your help. Mr. Treasurer, thank you. Jim, Josh, thank you. We'll be talking some more soon. Patrick.